Mark Twain, a very famous writer, once said that history never repeats itself exactly, but rhymes like saying that it looks a lot alike is like when you swing on the swing, you never arrive exactly at the same place, but you always move forward and backward. Sometimes when we are in the present, it's difficult to know what will happen in the future. But if we step back a little and look at history from afar, we can see that there are certain patterns that repeat. It's like if we're looking at the swing from afar, we can see how it moves forward and backward. In this video, we'll talk about some things that are happening right now that have happened before many times, but no one has noticed. For example, we'll talk about the interest rate, fiscal situation, debt, inflation, and deleveraging. All of this may sound a bit complicated, but don't worry, we'll explain it in a simple way. The important thing is that there's an interest rate cycle, which is the price you pay when someone lends you money. It has just reached its peak and is about to change direction. What does this mean? Well, imagine you're on a roller coaster. When you reach the top of a hill, you know you're going to go down very fast. The same happens with interest rates. When they reach their peak, they're going to go down. Why is this important to know? Because today's financial advisors and economists have only been working for the past 40 years, from 1980 until today. During these 40 years, things have been very predictable and have gone in one direction. But before 1980, things were going in the opposite direction. During 40 consecutive years from the 1940s to the 1980s, very few active investors remain who still invest today. All the statistics, advice, information, and data given as common advice on how to invest are based on the last 20, 30, or 40 years. Now that we're heading in a new direction opposite to the last 40 years, the traditional advice based on the last 40 years is no longer applicable. It might be exactly the opposite of what you need for the next 4 decades. If the near future doesn't resemble the recent past, it means that what will work in the future won't be the same as what worked in the past. So if we want to know what will happen in the future, we have to look at history and see what has happened before. This way we can get an idea of where things are heading. This chart shows how the interest rates of the US Treasury have changed in the last 40 years, from 1980 to 2020. But what is this Treasury and its rates? The US Treasury is like a giant piggy bank where the government keeps its money and also receives money from others who want to lend it money. So when the government needs money, it sells something called treasury bonds. These bonds are like papers that people buy to lend money to the government. In return, the government promises to pay back that money after some time, along with a little extra money, which is what we call interest. Well, during the last 40 years, something very interesting happened. In the late 1980s and early 1981, interest rates reached their peak. This was just when the Federal Reserve was raising rates to control inflation, which happened in the 1970s. But after that, interest rates started to decline from 1980 to 2020. Interest rates were falling. Everyone remembers what happened in 2020 when interest rates reached zero in all areas. You could get a fixed-rate mortgage of 2.5% for the next 30 years. That's like free money. So in summary, we had a 40-year cycle in which interest rates moved from a peak to a minimum. They couldn't go below zero and didn't go up much. At the peak in 1980, a slow long-term reduction in interest rates can be good for the economy. When interest rates drop, people can accumulate more debt without worrying too much about paying it off. This is because the cost of making debt payments doesn't rise as much, and every 5 or 10 years, the cost of acquiring new debt is cheaper. This means that the prices of everything can rise more because people have more purchasing power, and even though they have more purchasing power, it costs them nothing extra. They can pay more for a house, they can afford more for assets, and companies can afford more for acquisitions, research, development, and hiring. Yes, when interest rates drop, this can make prices of goods and services rise because people have more purchasing power and can pay more for things. But even though prices rise, this can be good for the economy overall. From the perspective of the gross domestic product calculation, which is a measure of how much a country produces, this can be positive because it means that people are spending more money.
From the tax perspective, it can also be positive because if people spend more money, the government collects more taxes. From the perspective of asset valuations, like the price of houses or stocks, it can also be positive because it means that those assets are worth more. So even though prices rise, everyone is happy with the deal because it can be good for the economy overall. Well, everyone except the poor, who don't understand what's happening. This means that during a period like this, where interest rates move from a peak to a minimum, you'll want to invest. You'll want to get into debt. You'll want to buy assets. You'll want to be in stocks and long-term bonds. Bond values rise as interest rates fall. This is because the bonds you already have pay higher interest than the new bonds being issued with lower interest rates. So people are willing to pay more for the bonds you already have because they give them more interest. But as we saw in 2020, interest rates hit rock bottom. This means that the cycle has ended. But before we see where we're going, we have to see what happened before 1980, because that will give us some clues about where we're heading from here. But if we step back, as we said at the beginning of the video, and look from 1940, precisely 40 years before the peak in interest rates, we see that interest rates were completely low, around 2%. This was because interest rates had been falling before 1940. Interest rates hit rock bottom in 1940 and started to rise from there, during the next 4 decades until they reached their peak in 1980. So we have a 40-year cycle where interest rates rise and then fall and then rise again and then fall again. If that's true, we would expect to see some similarities between what's happening today and what was happening in the early 1940s. This chart shows with the blue line the change in government debt and with the orange line non-federal debt of people and businesses as a percentage of gross domestic product in recent years. That is, how much debt there is compared to all the money the country produces in the 1940s. There was a generational banking crisis where non-federal debt began to fall, meaning people and companies owed less money because during the crisis, they requested fewer loans. While federal debt began to increase significantly because due to this crisis, the government borrowed more money. This also happened in 2008 to 2009 when there was another generational banking crisis. Non-federal debt reached its peak and fell from there while federal debt increased from there. We can also see with the gray lines how the federal deficit has changed with respect to gross domestic product. That is, the deficit is the difference between how much money the government spends and how much money it receives in taxes. If the government spends more money than it receives in taxes, it has a deficit. To cover that deficit, the government can borrow more money, increasing federal debt. In the 1940s, the federal deficit soared to pay for war expenses and to produce more. Today, we're not even close to that amount of borrowing, but we're heading in that direction quickly. The blue line shows how the total money supply has changed as a percentage of gross domestic product in recent years. The total money supply is a measure of how much money is in circulation in an economy. In the 1940s, the total money supply increased until it reached its peak, and then declined. From there, in a similar way, starting in 2008, we saw that the monetary base began to increase, but it hasn't been until now that we are at the highest point in all of history. That's why we're experiencing so much inflation, and prices have risen so much. In other words, during the pandemic, the largest amount of dollars ever printed was done to give them to citizens to spend so that the economy wouldn't freeze, and the machinery would keep running. We can also take a look at the differences and similarities with the federal deficit spending in the 1940s versus today. As we saw at the beginning of the 1940s, the federal deficit soared as it borrowed so much money. The Federal Reserve had to control it, represented by the orange line, the yield curve, and prevent its interest rates from rising too much. If they did, it could be challenging for the government to borrow money because it would have to pay more interest. Today, we're not even close to that amount of borrowing, but we're heading in that direction rapidly. The national debt of the United States is increasing a lot right now. In just the last month, it has increased by $851 billion. Much of that money went to replenish the general treasury account, which is like the government's checking account. Interest rates at this time are much higher than they have been in 10 years. For the 30-year treasury, we have to go back to 2011 before rates were so high, and for the 1-year treasury, we have to go back to December 2000. Now suppose that year ends and you don't have enough money to pay them that $105. So you have to borrow more money to pay it off, but it turns out the interest rate on that new loan is 10%, double the interest rate of the previous debt. But you borrow the money and pay off the old debt. Now you have to pay $10 in interest each year instead of $5. Even if you tried to spend less money and save to pay off your debt, you would still have to pay more interest each year because your debt is becoming more expensive very quickly. You would have to cut all your other expenses just to be able to pay the interest on your debt. Even if the government tried to spend less money and balance its budget each year, the interest portion would increase. They would have to cut all other expenses. So, even without increasing other parts of the federal budget, the government would have to spend more each year just because the interest on its debt is becoming much more expensive very quickly. The problem is that the government has these little things called mandatory outlays. These are amounts of money that the government has to spend by law on programs like Medicare and Social Security. Due to the age of our population, these costs will keep increasing in the future. So basically, due to interest and mandatory spending, federal government spending will continue to grow. They don't make enough in taxes to pay for that, so they will have to borrow even more money to pay for all that. They borrow money, spend it, borrow more money for expenses, and to pay the interest on the previous loan, spend it, and pay off the old debt. So they keep borrowing more money to repeat the process. But if it reaches a point where the government has a lot of debt and has difficulty paying it, the Federal Reserve can help the government by printing money and buying its debt. That is, they are paying the original lender the money the government owes them. And now the government owes the money to the Federal Reserve instead of the original lender. That's called yield curve control, but there's a problem with this. When you print more money, the money is worth less. That's when inflation increases. It means prices go up and everything becomes more expensive. When the Federal Reserve prints more money and buys government debt, it can make short-term interest rates lower for the government. This means that the cost for the government to borrow money becomes cheaper. However, when there is more money in circulation, it can lead to inflation. When this happens, long-term interest rates can rise for everything else. It means that if you want to borrow money long-term, you have to pay more interest. So, while the government can get cheap debt in the short term, everyone else may face a higher cost of borrowing in the long term due to rising inflation and interest rates. Banks won't want to accept an interest rate that is lower than the inflation rate because they would lose money by lending it. They will want to be able to compensate so that they are reimbursed at least as much as inflation. In summary, the government needs money to pay the debt it has. The Federal Reserve lowers interest rates to be able to print a lot of money and give it to the government. With more money in circulation, money is worth less. Then inflation increases and the prices of things go up. To reduce it, the Fed will have to change course and now raise interest rates high for a long time. This way, the government can borrow money almost for free, but everyone else has a really high cost of borrowing. If we look at the interest rate of 10-year bonds, we can see that it is exactly the direction we are heading. Rates bottomed out in 2020 and have been rising since then. With all that we've explained, the cycle is expected to unfold again over the next 40 years as interest rates continue to rise, maybe peaking somewhere around 15 to 20%. However, there is a second way this can unfold, and it's through deflation. This means that the government can't get enough money, either because it can't borrow more or because it can't collect enough money through taxes. If this happens, the government has to spend less money, but this can also make things tough for everyone. For example, if the government can't pay its debts, the people who lent money to the government might start to worry. They may think they won't get their money back, so they start selling the bonds they bought from the government. This makes interest rates go up. When interest rates rise, people have less money to spend on other things. Then the prices of things can start to drop. This is called a deflationary death spiral. Prices keep going down and more people can't pay their debts. Then interest rates go up even more. Now Powell, who is the head of the Federal Reserve, has said that if inflation continues to be high, it's possible that the Federal Reserve may decide not to help the government get more money. This means the government would have to spend less money, but there's a way out of this situation, and it's called deleveraging. This means reducing the amount of debt. One way this can happen is if there's an increase in the productive workforce. For example, after the war, many men could come home and start working and producing things again. This means that instead of being at war, where they are not producing things and maybe destroying wealth, they are now working and creating wealth. But not only men can start working and producing things. The inclusion of women in the workforce since 1980 added many more people to production. This means more people are working and producing things, and there's more money for everyone. It was for these two reasons that the United States was able to deleverage. This can also help reduce the amount of debt. Imagine you have a debt of 50 coins. If you earn 50 coins a year, it will be challenging to pay that debt. But if you spend those 50 coins on learning something new, like programming, and then get a job that pays you 200 coins a year, then that debt of 50 coins will no longer be a problem because now you earn more money and can easily pay it. This is what happens with economies when more people are working and producing things. more money is generated for everyone, and it's easier to pay off debts. However, the world is undergoing a change, the consequences of which we are not yet seeing. In the United States, the birth rate has been decreasing since the 1960s. This is called the fertility rate, referring to the number of babies born per 1,000 people in a year. For the population to remain the same, each woman should have at least 2.1 children. This is called the replacement rate, and it's the minimum number of children per woman for the population not to decrease. But in the United States, the birth rate has been below 2.1 since the 1970s. Despite this, the population has continued to increase thanks to people coming from other countries to live there. Due to immigration, the United States has been able to maintain its status as a global power. There aren't many men who can work after returning from a war, and almost all women are already working. If the country wants to produce more, it has to allow more people to come and live there. In the future, artificial intelligence may help increase production. Artificial intelligence can learn, make decisions, and perform tasks without needing someone to tell it what to do all the time. In the future, there may be artificial intelligence in every industry, helping to produce more. For example, there could be robots in factories doing things that people used to do, or there could be programs that calculate and analyze very quickly to help make decisions 24 hours a day without taking breaks or getting sick. We are at the birth of a new industrial revolution. It's important to know that things change over time. As we've seen from 1940 to 1980, interest rates, the money you're charged for borrowing money, were increasing. So if you wanted to borrow money, you had to pay more interest each year. But from 1980 to 2020, rates were going down to zero in 2020. Now rates are starting to rise again. That means the next 40 years will be different from the last 40. The government is spending more money than it has, and that makes things change. When the government spends more money than it has a deficit, and it has to borrow money to be able to pay for everything it wants to pay for. When there's a very large deficit, there can be inflation, where money is worth less, and everything is more expensive, or deflation, where money is worth more, and everything is cheaper. In either case, rates will go up because the government needs to borrow more money. That means things will happen that we haven't seen in a long time, like what we explained about the yield curve, a massive increase in productive output thanks to artificial intelligence, and debt monetization, where the government pays off its debt by printing more money. And most importantly, there will be a new normal for investment with common sense. This means people will have to think differently about how to invest their money to protect it. There are ways to invest your money so that it doesn't lose value over time. For example, you can invest in things that give you a cash flow, money that you receive regularly, or in high-grade debt, loans to people or companies that have very few chances of not paying. You can also invest in technology stocks or passive index funds that invest in many different companies. The important thing is to be prepared for the future and know how to protect your money. There are ways to invest your money so that it doesn't lose value over time, because what is clear is that with all these things we've explained, we've just begun a new stage of economic change for another 40 years. Thanks for watching, guys. I hope you enjoyed the video. Please leave a comment. Also, please consider liking and subscribing. I would really appreciate it. Thanks.